Good evening and welcome to the webinar hosted by UTI Fund. Today we will talk about fixed income markets. So this webinar is focused on an overview on the fixed income markets, and I welcome you both to the webinar as well as I hope you would see a lot of questions coming in from the audience. So with those opening remarks, I'll proceed. This market overview is largely focused around a few slides and charts that I'll present to you to talk about the trends which are impacting our fixed income markets. So to start with, I guess some of the key highlights which have really developed into the outcomes you'll be seeing today in the fixed income market are largely shaped by risks on inflation. We've seen elevated commodity and oil prices which have significantly impacted our inflation trajectory, as well as inflation for other markets as well. Global food inflation, again, something which has picked up significantly in the current year, was not seen for many years prior to this, and that again poses a significant risk. While some of these inflationary risks have come off, and we'll talk about that in subsequent charts, but at the present juncture, I would say that some of these risks are still out there. We just don't know what could trigger another bout of price rises as far as commodities and food is concerned. Obviously, we've seen escalation in geopolitical issues. The Ukraine-Russia conflict continues to simmer, and we're not seeing any resolution on that. That continues to keep a fair amount of risks on, particularly the commodity prices. We've also seen some bit of impact in terms of the trade flows. Hopefully, the economy have adapted a little bit to it and have taken that in the stride. But clearly, June of this year was the peak period when the conflict really sort of spilled over into everything in terms of commodity prices, oil seeds and so on, and did impact fixed income markets. Of course, the government borrowing in the current financial year is now well known, and sort of a smooth execution of the supply and absorption of that supply will dictate how these move. We've seen a remarkable hawkishness coming in from the US Federal Reserve. From an earlier expectation where the terminal Fed rate was targeted at between 3.5 to 4, clearly the developments of late have taken up the sort of terminal Fed rate much higher. The latest dot plot, which was released in September, actually indicated that you could see the Fed rate as high as 4.5%, sometime next year, which does indicate that there is still some space left for Fed to keep hiking rates. Of course, for India, RBI has been prioritizing inflation over growth, which is quite welcome because we have seen a lot of concern on the way the headline inflation has been playing out in India. Thankfully, the outlook going forward is one of inflation coming off, and that I think will be a key determinant of how bond yields going forward. Liquidity surplus in the country clearly is shrinking. We've seen surplus liquidity in the pandemic period, which was one of the monetary policy tools used by RBI. Now, given the fact that RBI is, in a way, recalibrating its reversal and tightening monetary policy, clearly liquidity is shrinking, and that I think will also determine how the short-term rates will going forward. We've not seen any meaningful FII flows coming into fixed income markets. In fact, they've been largely negative. But thankfully, for the month, we've seen some marginal inflows coming in. This was on the backdrop of news around a possible index inclusion. Unfortunately, that news is also fizzled off because we've not seen any meaningful development or clarity going forward. So I guess that is clearly a sentiment damp. So where are we right now in terms of global trends? If you look at global bond yields, you would see that across the board, whether it's the LATAM, Asia, or in the developed markets, we've seen yields move up both for the month as well as on a financial year to date, which is from March onwards, meaningful increase in yields. And if you look at the numbers, I guess the only outlier here would be Japan, which actually is following pretty much of a passive monetary policy, unlike the rest of the world, which is focusing on tightening. And most of this has been driven by the tightening that's been followed by the central banks of those respective countries. You would see for the major economies, largely in the West, who are grappling with very unusual levels of inflation. Clearly numbers that we've not seen at least over the last decade or so, have been tightening much more in a correlated manner. So you've seen meaningful rate hikes by those central banks, largely led by the US Federal Reserve, and then of course followed by Bank of England. Even ECB has hiked rates this year, and this is clearly spilled over into the rest of the world as well. Unlike the developed markets, which are facing unusually high levels of inflation, both as a result of the kind of fiscal stimulus that they've provided and very easy monetary policy followed by them, rest of the world, particularly in the emerging markets, actually do not face the same issues. They do have inflationary pressures, but since the fiscal stimulus during the pandemic period was not very significant, they've not really had the same levels of heightened inflationary trends. Looking at India, like I mentioned, clearly system liquidity is shrinking rapidly. This is a function of the VRRR. This is a function of the fact that there has been a significant amount of lack of intervention from RBI. On the liquidity front, they're no longer supporting liquidity through OMOs and other tools. And on the other side, we've also seen capital outflows taking place in the country, which is impacting domestic liquidity. Thirdly, we are also heading into a busy festival season, which will see continued shrinkage because of increase in currency circulation. And I think that will continue to keep liquidity more or less. Right now, it's sort of balanced. It's not yet moved into a significant deficit. But we think at least over the next few quarters, the liquidity could be more or less in the neutral to marginally positives. One good feature that we've seen over the last month and quarters clearly has been in terms of credit growth. If you look at the credit growth numbers, they've actually almost reached the levels which we saw pre-pandemic. So clearly on the growth front and from a bank's perspective, credit growth is very strong, which is a good indicator of growth. One big worry for India clearly has been around inflation. And if you look at the inflation index, driven largely by the commodity prices, an unprecedented increase that we've seen through most of 2021 and 22. Thankfully, over the last 6 months, after peaking off, we've seen some decline in the commodity prices, which is helpful because we've also seen its impact on our inflation trajectory, both at the wholesale price index level as well as on the consumer price index. This chart actually shows you, specific monthly and 6-month kind of impact. What's really relevant for us clearly is the crude oil, the metals like copper, aluminum, steel, and some of the food items like wheat, palm oil, which are relevant for India. And all over these commodities, we've actually seen a marginal to a significant decline, except I guess wheat, where there's actually been a bit of an increase. This is also reflective of maybe some bit of reduced crop shortage that we may see in India as well. Moving on to the key determinant of fixed income markets and its outlook clearly is inflation. If you look at the chart on the left, you would note that for India, inflation has been a concern, with inflation being for almost 9 consecutive months well above the 6%, which is the upper threshold for RBI. That's the orange bar that you see in the top left part of this chart. Thankfully, the outlook going forward, which is reflected in the blue bars, is one of a declining headline CPI. This is partly to do with the positive or beneficial base effect, which will kick in for the second half of current financial year. Also to do with the fact that, like I mentioned, over the last 6 months, we've seen a meaningful decline in some of the commodity prices, particularly crude oil. And of course, there is some element of decline as far as the food inflation is concerned. However, what's really of concern for India still remains the core inflation, which is the orange line that you see, the middle of those bar charts. And you would note that, it continues to be well above 6%, which in a way reflects the fact that there has been an incomplete transmission of all the input price pressures, which the manufacturing sector and the services sector have seen. And those prices continue to remain sticky, but they're not declining to the extent we've seen in commodities or food and or retail fuel prices. And that, I think, will continue to be a concern. So we may actually end up in a situation, as you would see in this chart, somewhere around October to December 2021, where the headline inflation, as reflected by the orange bars that you see, they are declining, but the orange line that you see at the top, which is the core inflation, continues to remain pretty much flattish. I think such a scenario is quite likely going forward. But for India, I think what's also comforting is the fact that overall inflation is likely to trend well below 5.5%, which will be quite comforting for fixed income markets. And on the other side, we've also seen a big impact of commodity prices being reflected in the wholesale price index, which continues to decline. No surprises. We saw a recent print for the month of September coming out just this month, and it was pretty much in line with the market expectations. So there was no negative surprise as far as the latest CPI print is concerned. Going forward, like I mentioned, in terms of growth, all positive indicators, the current trend series as well as expectation of growth going forward, both from RBI's perspective, including in its recent monetary policy review, has indicated that we will see overall growth ranging, between 6.7 to 7%, which is a healthy number. In spite of revisions that you could have read about from IMF, it's still heartening to know that India will continue to be one of the fastest growing economies, even with a real GDP growth rate between 6.7 to 7%. So that's positive. It's also reflected in terms of the PMIs that you see in the right-hand side chart on your screen. Both services as well as manufacturing PMI continue to be fairly firm in the expansionary zone, which is indicating a number well above 50. In terms of fiscal deficit, we've seen a year of concern, particularly post-pandemic period. It's not a meaningful decline that we are seeing in fiscal deficit, and that really has been a concern for the markets in terms of the large supply of bonds, both from the center as well as the states. Thankfully, so far, the absorption or demand has been fairly stable, and we've not seen any extraordinary impact in the yields because of the large announced and calendar of supply. But on the other side, what is really notable is that the fiscal deficit number going to decline going forward? I think we are seeing a fairly strong buoyancy as far as tax collections are concerned. We've seen one of the highest GST collection numbers, that we're tracking for the last so many years, and that I think is a good trend for overall fiscal position. If we are able to sustain those and there are no extraordinary expenditures, then I think to some extent one can see some more fiscal consolidation going forward. The worrying feature, I guess, is the blue bar that you see over here, which is on the current account deficit. I think after seeing a very moderate current account deficits for almost 2-3 years, we've actually started moving into a zone where our current account deficit is exceeding 2.5%, which is primarily being driven by, like I mentioned earlier, very high energy prices. So clearly the trade deficit has widened. There's an expectation that with the moderation we've seen over the last 1 month, crude oil prices, as well as some bit of slowdown that is expected in demand because of overall economic slowdown, one could actually see some moderation there, going forward. However, 3 to 3.5% will continue to be an overhang for the overall macro situation for the country. So what has happened in the bond markets? Now, if you look at the yield curves, this chart actually shows you how the yield curve has moved everything from 3 months to 40 years outside, right from 1 month ago to 6 months ago, which is period of March 2020. So over the last 1 month, clearly you've seen the yield curve decline. This is reflected in the blue line, which is 1 month ago figure, and the green dotted line, which is the latest yields across the yield curve. So you've seen a bit of a decline over there. However, when you look at where we were versus March, you would note that there's been a significant increase. In fact, this chart clearly shows that at the short end, which is 3 months outwards to 5-year period, we've seen a much higher share of increase in the yields versus at the longer end, which is 8 years onwards, right up to the end of 30, 40 odd years. There, the increase is much lower. So this is effectively what has led to the flattening. But over the recent 1 month period, there's been just a marginal increase as far as yields are concerned. So I think that's again where the markets are reflecting their views. The flattening obviously reflects the fact that there is a significant increase in short-term rates, which is going to be affected through RBI's tightening and the rate hikes that they've undertaken so far. And how has the 10-year moved? Again, this sort of chart also shows you how the 10-year has moved over the recent years and recent month as well. You would note that through most of 2021, these have been largely somewhat range bound. But since December of 2021, they have been in a rapid increase. And this is obviously a reflection of markets' expectations that RBI will have to start hiking rates very soon. And this is effectively being reflected there. So we saw the 10-year yields peak at about 7.61 sometime in June, like I mentioned earlier. And since then, they have actually declined a little bit. They did decline in spite of the rate hikes which RBI has undertaken. So they've taken the repo rate all the way up to 5.9. But what's really also happened is that the markets have also sort of, in a way, reconciled in terms of their expectations. So earlier, in the sort of peak of bearish sentiment and sort of fear, the markets in terms of the swap rates were indicating the terminal repo rate at close to 7.5%. Since then, there has been a lot of moderation in expectations, and we've seen terminal repo rate move all the way down to 6%, which is where you see the 10-year yield actually at being just a little above 7%. This is also helped by announcement, or at least possible announcement, of index inclusion, which was the news flow through most of August, which helped yields rally a little bit. Over the recent 2-week period, clearly the index inclusion news has sort of fizzled off because there is no further clarity and likely delay as far as index inclusion is concerned. And on the other side, we've also seen a meaningful hawkish statements coming in from the US Fed, and an indication that they could hike even further from here. So all these two movements have actually led to a marginal increase that you see at the right end of this chart in terms of the 10-year yields. So this slide just shows you how the various segments in terms of the maturity buckets and the rating, both the corporate sector, AAA and AA's, have moved both over the previous month as well as on a year-to-date basis. So nothing meaningful to report over here, but you would note that across the board, across maturity buckets, we've seen yields inch up. That clearly seems to be the broad trend as far as yields are concerned. This is an interesting chart which actually shows you how the 10-year yield versus the repo rate has moved over the last almost 7-8 years, and this is reflected in the term in terms of this term premium spread, which is the 10-year yield minus the repo rate. And you would note that there has been a significant decline as far as term premium spread is concerned. And this is largely a reflection of the fact that RBI has actually started hiking rates and has narrowed the differential. So in spite of, like I said earlier, in spite of RBI hiking rates, you would note that the 10-year yield has not continued to sort of trade at the same spread over the repo rate, which is again a reflection of market expectations that as RBI continues to tighten, inflation should start coming off, and hence markets need not demand a higher premium for longer dated securities. So historically, we've seen much tighter term premium spreads, but I believe in the current cycle, we will probably start averaging close to about 200 odd basis point of spreads. It's unlikely that they would decline unless you actually start seeing a meaningful decline as far as inflationary expectations. So if that were to happen, then I suppose you can actually start seeing term premium spreads narrowing all the way down to 100 odd basis point or sub 100 basis point, which will be again moving over to the trend line or the historical levels as far as term premium spreads are concerned. This again chart actually shows one of the reasons why central bank actually had to start tightening and clearly tighten in a fairly aggressive manner. We've seen negative real policy rates as well as negative 1-year forward rates for a fairly prolonged period of time, and this is really not sustainable. It has its implications on currency, it has its implications on savings rate, and it also spurs a higher level of consumption demand, which in a way further puts pressure on inflation. So clearly, we've seen a significantly high levels of negative real policy rates. During periods where we had sort of more or less inflation under control, or within the 4% plus minus 100 basis points sort of range, as far as RBI targets are concerned, we've seen real policy rates being meaningfully positive. So even RBI has articulated in its monetary policy statements that they would want to see the policy rates being somewhat positive going forward, and that would be part of their objective in terms of their monetary policy targets. So I think that clearly would mean that if you are likely to see inflation trending on an average between 5.5% to 6%, then clearly the repo rate has to be higher than 6%. In terms of flows, nothing much. In fact, I think for fixed income markets in India, we've only had 2 great years as far as foreign portfolio flows were concerned, and these were calendar year 2014 and calendar year 2017, where we had 20 plus odd billion of portfolio flows coming into domestic bond markets. Since then, it's been largely negative, and it's only in the recent month that we've seen a marginal uptick. Let's see whether that sustains. But given the risk environment in the global markets, it's unlikely that we will see meaningful portfolio flows coming in from foreign investors in local markets. There was, like I mentioned earlier, a hope that an index inclusion would bring in meaningful flows into our local markets. But that again does not seem to be happening anytime soon. On the other side, clearly mutual funds have been big participants in the domestic bond markets, and you've seen it driven by significant flows into the funds. So they've been very active participants across different years. Obviously, the share has been reducing of late as the AUMs of fixed income funds within the mutual funds are not growing with the same pace as they were prior to the pandemic period. But again, I think they've clearly been fairly active participants in the domestic bond markets and have been helpful in sort of both supporting the yields as well as taking active positions wherever required. So just to sort of quickly summarize, both the market insights and outlook. Clearly, we talked about geopolitical tensions and its impact on commodity prices. We think a lot of it is already behind us. But if it were to flare up, or if things were to start getting a little bit more messy, then I guess you could again start seeing some bit of heightened risks as far as commodity prices are concerned. On the other side, RBI did hike the August and September policy at 50 basis point. We think if there is still some scope for them to hike going forward. Our expectation all along has been that the repo rate should be between 6 to 6.5%. But given the recent developments, we feel 6.5% is more likely. Again, this is built on the backdrop of the likely inflation trajectory going forward. Like I mentioned, while inflation will come off, but on an average, it is likely to stay still around 5.5%, which means that anything less than 6% on the repo rate will not be sort of a neutral rate from RBI's perspective, and maybe they should, given the risk environment that exists globally, should actually budget for a slightly higher margin over there. So 6.5%, I think, is more likely in the present environment. However, if you were to see a global recession, or if inflation, because of maybe some resolution of the conflict in Ukraine, Russia, or sort of the recession that we're talking about, bringing demand down for commodities further puts pressure on commodity prices, and inflation comes off, then I think there will be some respite for RBI not to hike the extent of 6.5% going forward. Other than this, I think from an investor's perspective, clearly there still are meaningful risks which have again come back center stage, largely driven by how the US Federal Reserve really plays out its monetary policy. We have very important policy meetings over the next 2 months, which is November and December. and they will be very closely watched because, like I said, market expectations from US in terms of the Fed futures are indicating that the Fed rate could go as high as 5, whereas the current dot plot, which was last revised in September, indicates a peak, Fed rate of 4.5%. So I guess markets will very closely watch what is the signal sent forward by the US Federal Reserve in terms of the dot plot, and also, the extent of comfort they are deriving from the current inflation trajectory that they see. So that, I guess, along with domestic inflation trajectory going forward, will be the key drivers as far as our markets. From an investor's perspective, I would say that, given this sort of an environment, we feel you can look at, somewhat low risk strategies like the roll down allocation, that you can look at some of the roll down strategies that we have in our funds. Some of the actively managed duration categories, which, like I mentioned earlier, we think, while the yields could move up further from here, if the US Federal Reserve was to be about more hawkish and RBI actually has to follow suit. But, there's not a significant increase that we're looking at from here. So the range could be between 25 to 50 basis points, which means that for an investor who's looking at actively managed duration category of funds, you can actually look at allocating money in a staggered manner, which could be the form of an SIP, a monthly or a fortnightly SIP. You could use the dips as a, whenever you see a sharp uptick in the yields, it's a good entry point for looking at longer duration funds. And for the rest, for the low risk investors, I would suggest, look at matching your maturity, your investment horizon with the maturity of the underlying fund. That would be the strategy for fund allocation. Moving on to just a quick comment on our investment framework and fund strategies. At UTI, we keep talking about something called GIMS, or GIMS framework, which is an acronym for Gate, Investments, and Monitoring and Surveillance. And I want to just quickly touch upon this because this really is the bedrock of how UTI looks at investments in its fixed income fund, as well as the kind of strategies that it will run across its fixed income categories. So the G, which is the Gate, largely encompasses onboarding an issuer, which is bringing in a new name or a new company into our investment universe. And that's really the role of Gate, where it is filtered through series of both internal research as well as certain parameters before it is selected for being part of our investment universe. Once it's part of our investment universe, that's when fund managers can then selectively choose to invest in whatever duration or maturity buckets that they're interested in as part of their overall fund strategy within what is permitted for each of the funds. And this is where we come to the investment framework. Now, the investments as part of our GIMS framework largely looks at the fund strategy framework, which is a function of three aspects. We look at fund strategy and style, and this basically, in a way, puts forward what a fund can and cannot do in terms of what kind of a rating profile it can invest in, what kind of a security profile it can invest in. Then, of course, there is an element of risk management framework where it's very clearly articulated what is the lowest rating threshold, what is the concentration it can have, and again, in terms of whether it can invest in certain bespoke structures or instruments or not. Finally, coming to the potential risk class metrics, this is again a regulatory requirement, which also factors in on two spectrums, both on duration as well as on the credit quality, how a fund is positioned. So in a way, it actually puts your fund in a certain selected box where a fund is sort of restrained from taking on a certain level of risk. So it defines what is the maximum risk and the maximum duration a fund can take. I think these three elements clearly do put a fairly rigorous structure around what a fund manager can do with the fund and the kind of strategies that he can. So clearly, that's part broadly of our investment framework. And then, of course, the monitoring and surveillance, which is a very important element of any framework. So in UTI, monitoring and surveillance looks at both pre and post investment surveillance. This is everything from not just monitoring or reviewing the investment universe, but also looking at market data analytics to see what's really happening in terms of broader trends in terms of liquidity of an instrument or of an issuer, looking at preference for a certain type or class of instruments. It also looks at early warning signals. So there are elaborate set of parameters that a separate source we have in our research team who looks at just early warning signals and monitors a lot of these parameters that we have highlighted. There are a whole host of them, and be very happy to discuss more at length. But clearly, these three parameters are used in terms of both investment decision making and in terms of the kind of strategies that each fund will run. So, just with that, clearly, sort of to articulate a few important elements in here. In terms of gating, clearly the primary source for us is our internal credit research team. We have a fairly seasoned credit research team consisting of 6 analysts presently, headed by a head of credit research. Then, of course, market intelligence or market information comes in from our dealers who are actively engaged in the markets. We also use our strategic partner, Europrise, for understanding on what's happening in terms of the global markets. And then, of course, on the investment front, like I said, you have the fund strategy framework, which is very clearly articulated for each of the funds, and the investment universe with which fund managers will invest and create a portfolio. And we talked about monitoring and service. So just to sort of put it specific in terms of the numbers and data for each fund, what we talked about in the previous 2 slides, I would say that this chart is a good example of what we mean in terms of the fund strategy and fund framework. And as you would see, there are several rows on the left which classify certain specific parameters for each of the funds. And then obviously each of the column for the funds specifies what are the parameters in terms of actual numerical numbers that you can do or cannot. So I think this is very important. So in terms of duration, in terms of the rating file, mapped to long-term rating, not just short-term rating, in terms of the lowest rating threshold that the fund can invest in, what is the maximum exposure you can take at the lowest rating for each of the funds, and what you cannot invest in, which is, let's say, perpetual bonds in the case of the short duration funds that you see in the chart here. Similarly, we have a similar framework for 1 to 5 year duration strategies, very specific to each of those funds. And finally, in terms of the long duration or credit and kill strategies as well. So what is the minimum exposure you would have even to an asset class like G6? Whether you would or you would not invest in, let's say, perpetual bonds. So I think all this is very clearly articulated, and every fund manager is bound to operate this framework. So with this, I'll come to the final part of my presentation, which is what are the investment horizons and what kind of specific products we are recommending. I talked about broadly the current environment where there is fair amount of volatility, at least for investors who not want an added volatility in the portfolio. Please do match your investment horizon with the investment duration of the sort of the portfolio duration of the funds. And this is what we've articulated in this table over here. So the first column actually talks about what is the investment horizon that you should be looking at and what is the appropriate product, because those funds will operate within those specific duration buckets. And like the fund framework slide I had shown you earlier, which very clearly articulates that each fund has a defined duration band, even for funds where there is no regulatory requirement for sort of floor and cap duration. We have clearly defined what duration funds will operate. So that in a way, reduces any volatility. From your perspective, if you're coming for, let's say, 18 months to 24 months, then I think look at a dynamic bond fund, you look at a short-term income fund, which are appropriate products. They will manage the interim volatility and any risk that may emerge from yield movements on your behalf. So that's the way to look at some of these funds. So with that, I will end my quick commentary on the markets and outlook and product recommendations. So with this, what I would suggest is that request moderator to take in a few questions. Please feel free to write in with your questions or comments or any other observation that you make. Thank you.
Thank you, Amandeep, for your sharing your insights and views on the market outlook and UTI fund strategies. We request viewers to keep posting their questions on the link shared with them. And in the meanwhile, we have a couple of questions lined up. So the first question is, so do you think that the policy rate hike by RBI is already factored into the yield curve? What would be your advice to the investors who are looking at for the investments in the longer end of the curve? Should they wait for further rate hikes or no, can invest now?
Sure. Thank you for that question. I think that's a very important question in the current environment. Firstly, in terms of the market pricing, I would say that with the way we've seen the 10-year yield move back up to almost close to 7.5% levels, it does factor in a repo rate which is closer to 6.5 to 6.75%, which I think is a good point of entry for investors who are patient and have a investment price of 3+ years. So one way to look at it, and I alluded to it briefly earlier, is that you can't really capture or try and enter the markets when you think the rates have peaked. It's going to be very swift and it's going to be almost impossible for anyone to sort of catch in terms of the timing. So the best approach or the strategy over here would be that since we now are looking at a terminal repo rate which is around 6.5%, and the 10-year yield is already now back to almost 7.5%, and I alluded to the most bearish phase for Indian bond yields when the 10-year yield touched 7.61. So your margin of safety or your risk-reward ratio is actually turned in your favor. So a good way of using this opportunity would be, like I mentioned, do a staggered investment. Use or maybe do an SIP into long duration funds. So you're not looking to deploy all your money at a one particular sort of market level, but you're like portioning it over whatever yields could move over the next 1 to 3 months. I think that would be a more suitable strategy because whatever central banks have to do in terms of their tightening or in terms of their monetary policy will play out over next 3 to 6 months. So I think in this sort of an environment where you have this level of volatility, it will be a good strategy to start deploying money rather than try and time your entry at the peak yield levels.
Thank you for the answer, Aman. The next question is, at some point in time next year, the Fed will hit a pause button on the hike. So, however, how long and intense could be the overarching effects of Fed's hard landing on emerging economies, including India? And how prepared you think is India in the anticipation of the expected slowdown?
So I think, both in terms of US recession, which is reflected in the inversion as far as the US Treasury curve is concerned, which is also being talked about by most of the economists, US as well. Parallelly, its impact on global growth and on India in particular, I would say are known unknowns because, we already have seen some of those being priced in or factored in terms of the growth outlook, which the leading economists or the leading think tanks like IMF, World Bank have already forecast. In all these parameters, while you're right, US and greater part of the Euro region is likely to see contraction as far as GDP is concerned. No one has really sort of highlighted a very sharp decline as far as India's GDP is concerned. So, the numbers which are as recent as this week indicate India's growth at 6.8 and, at a worst case scenario, at 6.4 over the next 2 years. So I think that's a reasonably good number to look at, which is already pricing in the contraction or recession, likely recession. The other part, I guess, which is that, like you mentioned, there is a likely pause as far as rates are concerned. I think on that, as far as US is concerned, there is still a fair amount of uncertainty. So to give you a perspective, as far as the Fed's own projections are concerned, the dot plot indicates that by end of this year, the Fed rate should be around 4 quarter, and by sort of end of next year, the Fed rate should be between 4.5 to 4.65. So which means that we have at least another 100 odd basis point increase for the rest of this calendar year, which is by December. And then we have, maybe another 65 to 70 basis point increase for all of 2023 to reach 4.65 by end of 2000. So the possibility for pause right now is not being really indicated by the Fed. But let's say they were to revise their dot plot going forward, then I think that would give a lot of comfort to both global central banks because they don't have to follow suit, and it'll also, clearly benefit the risk assets, which is emerging markets, equities, fixed income, currency, and that I think would be a big, reason for markets to rally next year.
Thanks for the answer. So the next question is, with US dollar index nearing the levels of 2 decades ago, is INR insulated from global currency shocks?
No, not at all. I think, we have no choice but to follow suit, as is true for any other currency when dollar is strengthening, especially when you peg your currency with the US dollar. Now, if you look at, a lot has been talked about India's currency depreciation. But while we get sort of excited by, these sharp moves and the way, we reached 80 rupees and then 81 and then 82, the reality is that globally all currencies are depreciating when you peg them against the dollar. And for India, particularly for rupee, the good part is that when you look at, let's say, the 8 Asian currencies, which includes everything from Malaysian ringgit to Korean won to Thai baht and so on, of the 8 currencies, we are maybe ranked 5th or 4th in the descending order when you look at, rupee, when you look at the currency depreciation. Similarly, when you compare it with rest of the emerging markets, which include, again, LATAM and Eastern European countries, there are about 20 such countries to compare with. And over there, again, you would find that we would be ranked 9 or 11, between 9 and 11. So that's really been our 1, 3, 6 month and 12-month performance. So we are not an outlier relative to the rest of the world when it comes to currency depreciation. But the reality is that if Fed continues to tighten, if they do reduce their balance sheet, which means dollar demand will increase, currencies across the world will depreciate, and so will we. Our only insulation our only way of ensuring that we depreciate less than others are twofold. One is obviously that we ensure that our current account deficit does not balloon any further, which means we curb imports and try and push exports by really letting the currency depreciate. And the second is by ensuring that we actually achieve that neutral rate as far as domestic policy rates are concerned, so that there is no negative impact on the currency. So which effectively means, and this is again, a question I've been asked several times, that if, let's say, the US Federal Reserve goes to 5%, are we okay at 6.5% repo rate? Because, the differential will hardly be 150 basis point. And historically, the differential has been much wider. And I think my answer to that question is that, yes, we can sustain, repo rate at 6.5%, provided our inflation is below 6. So at that point in time, markets will compare the real policy rate to real policy rate, which means that for India, with inflation at, let's say, 5.5% and the repo rate at 6.5, we'll have a positive real policy rate of 100 basis point. Whereas for US, even with 5%, Fed rate, their inflation at what at least is being forecast right now by the Fed is close to 4.5 to 5% the next 12 months. It'll still have a negative to a marginal neutral, real policy rate. So it will definitely be in favor of India and in favor of rupee.
Thanks for that. The next question is, while the government continues with its various stimulus program, would it overachieve its fiscal deficit target, leading to further cuts in the growth estimate?
Actually, I would say that relative to rest of the world, the Indian government has actually not been very active in terms of fiscal stimulus. They've been fairly guarded. They have done selectively, wherever required. But at the aggregate level, I would say that there's not been a meaningful, fiscal stimulus provided by our government. So much so that markets actually have a fair amount of comfort in the 6.4% fiscal deficit number for the current year. In fact, nobody in the market right now is really factoring in any excess borrowing or slippage as far as fiscal deficit numbers are concerned. And I would say that there's been sufficient statements also coming in from the government officials indicating that the 6.4% fiscal deficit is in a way pretty much a hard red line for them. So that I think will give some degree of comfort for the markets. Markets I think currently are focused more on the terminal repo rate, more in terms of where RBI's sort of reaction to how the US Fed plays out. That's really where the markets are focused a lot more on. But I think on two parameters, fiscal deficit and in terms of the inflation outlook, the outlook clearly seems to be more benign.
Thanks. The next question is, how should one look at credit risk funds in the current market environment, and should one adopt any exit strategy in particular?
Sorry, did you say exit or investments?
Sorry, investment strategies in particular.
So I think if you look at relative performance of credit risk funds over last 1 year vis-a-vis any other high investment grade products, you would have noticed that the total return actually is far higher because of the higher carry and YTM that they had and lower duration that most of the funds were running. So on one hand, the sort of coupon that they were collecting was much higher than some of the other low coupon bearing, low duration or shorter funds who were running AAA portfolios. And at the same time, because they were running durations of maybe 1.5 to 2 years and not more than that, so their returns are also that much more protected from the interest rate hikes. But at the current juncture, I would say that the spread between a AA or a single A rated versus AAA has actually narrowed down significantly. In fact, one of the charts which I had shown, which really talked about how for everything from 3-year, 5-year, and 10-year AAA and AA yields, how they move, you would notice that the spreads really have not sort of widened. In fact, they've compressed meaningfully. So maybe going forward in a environment where you do see some degree of volatility, maybe investments in high investment grade portfolios, which are consisting of AAAs, will offer you slightly better risk-adjusted returns, primarily because whenever cycle peaks and changes, this is one rating profile that will be the first one to rally and show you some price gains. The other rated instruments will actually take some time. Of course, if you actually have a sort of a passive buy and hold strategy, you could possibly look at credit risk funds purely from the YTM perspective. This again needs to factor in the fact that we are presently in a slightly benign credit environment where we've actually seen rating upgrades exceeding any downgrades or output changes. So this actually is one of the best credit sort of cycles that we are in. We've not seen any significant stress for any sector or any corporate over the last 3 years. That I think is very comforting as far as credit risk funds are concerned. So you will actually have to evaluate, like I mentioned earlier, your investment horizon and what are the kind of returns that you want to target.
Thanks for that. The next question is, what should be the approach of investors at large for a time horizon of 3 to 5 years? Do you see any merit in investments into roll down strategies in that time framework?
Yes, in fact, like I mentioned, some of the product recommendations for us still are roll down strategies. Again, look at your sort of point of entry, right? I mean, you would note that the 5-year bonds are again back to the 735-40 kind of levels, which is a good point of entry because that's the kind of YTM at which you're entering, and you don't have to face any of the mark-to-market volatility that you may see over the next 2 to 3 years or even beyond. In fact, you are possibly getting a higher nominal entry point than even some of the fixed deposits which are being offered for the same maturity. So I think in terms of a low risk strategy, a roll down funds are quite appropriate. However, if you actually have 3 to 5 year investment horizon and you want an active strategy, I would say you also portion some money in actively managed funds, and especially the long duration funds, because clearly, like all cycles, this will also turn. And how do you capture that? So you need to have a bit of a mark-to-market component in your overall fixed income, right? So, like I mentioned, maybe stagger some investments in relatively longer duration funds as well. Not a high proportion, but still should have some allocation.
Thank you, Aman. The next question is, recent CPI inflation numbers shows an rise of 40 bips. So what are your views on the upcoming policy rate hike? In this?
I think if you looked at the September CPI print at 7.4, it was pretty much in line with market expectations. In fact, Bloomberg consensus was at 7.4, and I think that was really a comforting feature. If you looked at even RBI's own Q2 average CPI estimates, it was at 7.1. So if you looked at the average of the last 3 months, which is July, August, September, you would note that it more or less tracks that number. So no negative surprises, and that was one comforting feature. And like I mentioned, if you looked at the chart which we had talked about in terms of the inflation forecast going forward, I think we would tend to believe that whatever RBI has forecast is quite attainable. So you could see inflation dropping down to 5.8 by March of 2023, unless you see some extraordinary event like oil going back to $120 plus or so on. So I think that is very comforting. You must also note that the current inflation outlook by RBI is forecast at crude oil at $100 a barrel. We've actually seen crude being well below 100 for a good part of late September and now October. And hopefully, if that sustains for the rest of the few months, then you could actually see an undershoot on inflation. It should be again a big comforting factor for the markets. Now, how this translates into rate hikes, like I mentioned, we still feel that RBI should go and achieve 6.5% on the repo rate as soon as possible. Now, the timing is something which is clearly their prerogative. They could sort of front load this, or they could actually do it in a gradual and calibrated manner. But I think in the next policy meet of December, you would have seen the November rate hike from the Federal Reserve, which is scheduled in November. And of course, you would have the November inflation print as well, which should be lower than 7.4 that we saw. So with both the sort of inputs and maybe a strong growth that we will see given the we've seen the decent financial numbers being declared by corporates for the September quarter. We have very busy festive season coming up at Diwali. So again, it should spur some of consumption and demand. So I think all this clearly will mean that on growth, RBI should not have concern. On inflation, while it's trending down, but they still need to achieve their real positive rate kind of targets, which means that a 50 basis point, I think in December would be quite desirable. They may tweak it, it could be 35 or 50. I think the markets are also sort of debating. But our view is that they should actually try and do 50 as soon as possible, because after that, the next period when they can react is February. And for February, the Federal Reserve would have already had another meeting in December. So, rather than wait so long, I think it would be better than the 50 basis points.
Thanks. We will take another 1 or 2 questions. So the next question is, do you see substantial RBI interference to stabilize rupee depreciation? Would it not lead to depletion of forex reserve? No, so what are your views on that?
So I think your observation is correct. RBI clearly has been intervening in the FX markets to prevent any sharp or sort of high volatile currency depreciation. So that's possibly one of the reasons why when I talked about India being actually somewhere in the middle of the pack, it's also a function of RBI's own intervention in the FX markets. But this is pretty evident, right? I mean, if you looked at the way the FX reserves have declined, a good part of it is also because RBI has actually been using its foreign exchange reserves to intervene, supply dollars to the market whenever rupee was depreciating because of excess demand for dollars. So that I think is seems to be the strategy which has been actively pursued by RBI so far. We've already seen a decline of, I think the latest number indicates somewhere close, a little under or $100 billion. From peak size of 662, I think we're already down to 550 odd billion dollars. So this is already reflected in the decline. Incrementally, like I said earlier, we feel that just defending rupee on the back of your FX reserves, you will have to pursue the twin sort of strategies of ensuring administrative controls to reduce your current account deficit, and on the other side, also make sure that your policy rates align themselves to a neutral rate as soon as possible.
Thank you for that. The next question is, so gilt funds are known to be extremely rewarding during the reversal of interest rate cycles. And so when it is likely to begin the reversal of the rate cycle, and how do you see the investor should go about their investments into gilt strategies at this time?
So I already touched upon, how you can use current market sort of scenario to invest in the long duration funds. But added to that, I must also mention that if you had maintained a steady, stable SIP in a long duration gilt fund or even a constant maturity gilt fund, you will be surprised at your returns over a 5 and 10 year period. In spite of going through a global financial crisis, taper tantrum, sort of the pandemic period, and the present interest rates sort of hiking cycle, your 10-year returns from a gilt fund still range being 8 to 9%. That's a pretty decent, sort of a return profile. So just imagine if you were patient and sort of consistently investing in such a fund, and when the cycle turns, the upside that you would get, rather than just trying to invest for that 6 month or 1 year period where you just capture that upside, being a patient investor in some of these funds would have actually delivered you far better returns than you would have got from other comparable sort of instruments or investment options. So I think it's important to understand that there is merit in long-term investing in fixed income funds. I think I often find investors get swayed by what is pertinent for next 6 months and 3 months or 12 months. So there are certain allocation of your investments which should take place in the short duration funds because they provide you with liquidity, and that should be a sole driver. It should either be capital sort of preservation in a very adverse or volatile environment. In that case, maybe the short duration funds would be appropriate for an investor. However, if you're really willing to look at building wealth and looking to invest for long term, then the more desirable strategy would be to have some allocation on a consistent basis in some of these long duration or actively managed funds. Because you would have noticed a dynamic bond fund or a UTI gilt fund or some of these funds over a sort of a 8, 10, 15-year horizon have given you excellent returns. That's really key message I want to put across. You ask me a question of how should one time and how should invest in sort of these funds.
Thank you, Amandeep. So looking at the paucity of time, we are arriving close to our webinar. A request to the participants, please share your feedback on the link available and on the topics covered today and the webinar in general It will help us to know better our upcoming engagements with you. Thank you, everyone. Amandeep, would you like to share any closing comments?
Sure. So I guess nothing more to add from my side. Thank you all for joining in. I think it's a pleasure, and we will continue with these interactions going forward. I believe it's very important for us to communicate. It's very important for us to communicate with you on two fronts. One, given the level of uncertainty and maybe a bit of concern or apprehension around what's happening in fixed income markets and the way you've seen volatility in some of the debt funds. It's very important for us to communicate what's happening, what is really impacting the funds, and what should an investor do, and how should an investor really understand those moves. I don't think you should really be only worried and sort of be in a hands-off or a mode of not investing at all because you're seeing so much volatility or negative news flow. And on the other front, I guess it's also important for us to communicate to you how we manage our funds, how we run our strategies, and going forward we'll get into more detail, like I mentioned, each of the individual funds. That I think will help in a way demystify debt funds, in a way also help you understand what would be appropriate for you and your investors. So with those comments, I'd like to thank you all and wish you the very best, and stay safe and invest in debt funds. We do make real returns from investing in fixed income funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.